A big welcome from me, Guy Munson, to our 100th 6-Minute Strategy. As lockdown began in the spring of 2020, I started broadcasting our 6-minute strategies from my study in Somerset. Thanks to all of you who've watched so regularly through pandemics, wars, inflation and even AI, we have together reached our century, and I hope you've enjoyed the investment journey. To celebrate this, I've asked my long-standing colleague and dear friend of 24 years, Dr. Subita Subramaniam, our chief economist, to join us. Together we'll reflect on the extraordinary events of the last 4 years, what they mean for the future investment markets and for your portfolio in the years ahead. So welcome, Subita, to 6-Minute Strategy, our 100th edition. It's just lovely to have you here.
Such a pleasure to be here with you, Guy.
We've got the clock on us all the time. We've only got 6 minutes, so let's get going. The first chart is UK annual GDP growth back more than 100 years. And what you can see on the right-hand side is that COVID shock, which was happening just as I began broadcasting 4 years ago, was both the most violent in terms of a drawdown and almost in terms of an upturn. And that's taking wars, oil crisis, financial crisis. What is your takeaway from what we saw?
So I would say there was something that we can take away is that there was nothing fundamentally wrong with the world when pandemic hit. And really the recession was caused by the government shutting us all down. And therefore, when the stimulus came through, the recovery was equally aggressive. And so we rebounded really sharply. We really need to think about this in sharp contrast to 2008. When households were impaired because of the property market problems. We had banks that were looking at solvency risks. We had governments really on their back foot because they were bailing everyone out. And so the recovery from that crisis was much slower.
A big theme of your work has been to compare the extraordinary robustness of the US recovery with the relative sluggishness we've seen in Europe and the UK. And you can see here graphically, the blue line is GDP in the UK rallying sharply after the COVID dip, but then broadly flatlining. But look at this US train, actually travelling faster than it was pre-COVID. What's going on here?
So I think the problem here is that the UK has actually experienced a second shock after the pandemic. This came in the form of Russia's invasion of Ukraine, which really put a huge impulse into energy prices and therefore inflation. Inflation in the UK peaked at 11%, and the Bank of England raised interest rates 5 percentage points. And I think all of this really impacted consumer spending. And then businesses were really struggling with Brexit, lingering Brexit-related uncertainties. So they were really not confident in spending. Now, in contrast that to the US, which experienced a recession that was much milder than the UK, we have had a recovery that's not only stronger, but also we've had stimulus that's been much more aggressive and probably not needed, which has now pushed the economy way above its long-term trend.
And of course, a lot of that fiscal spend, that huge programs, the 3 huge programs of the Biden administration, there's a price to pay. Someone's going to pay back that debt, or at least in the meanwhile, pay interest on that debt. And when you look on the left-hand side there, which we've seen many times on this show, public debt in the US as a percentage of GDP almost past its World War II peak. Extraordinary.
Yes, and I think this is really a cause for worry for us and something we need to watch very carefully. I think the US can manage this because it enjoys exorbitant privilege. It borrows at relatively cheap rates for the amount of debt it has in global markets. Today, you can see from this chart here that the average interest rate that the US pays on its outstanding debt is about 3.3%. And this is okay and manageable for an economy that's growing at 5.5% on a nominal basis. But this has to be watched because there appears to be no plan, either by the Democrats or the Republicans, to bring that debt trajectory under control. And there is a risk at some point that markets look at the US and say, we really demand a premium to lend to you when you don't really have a plan to get your debt under control.
So yes, a risk of a trust-squatting budget problem across the US. But with interest payments going up from a few hundred million 20 years ago to over $1 trillion today, we've got to be alert. So you're a great Fed watcher, you're a fan of Jerome Powell, you've watched this policy work out very closely. One thing worries me. When you look at that left-hand chart, the blue line is inflation, his preferred measure. It takes off in late 2020. It takes him more than a year, though, to respond with interest rates or his balance sheet. Was he asleep at the wheel?
I think they were a little bit asleep at the wheel. I think they kept sort of repeating this mantra, which was that inflation was a transitory shock that was coming through because of the war, and it had nothing to do with the fundamentals of the economy. I think they were slow to get going, but they did make up for lost ground. When they did start raising interest rates, they went incredibly aggressively. The 375 basis point hikes in 2022 were unprecedented. I think it sent a really clear message to households, to businesses, and also to all of us in markets that actually the Fed was very serious about getting this inflation under control. And I think that arrested expectations.
And just for the last few months, last 3 months, we've seen numbers a little bit hotter than we'd like on the inflation. So can they manage this last mile down to 2%?
I think this last mile is going to be tricky because a lot of the reason inflation is so sticky is slightly outside the Fed's control. But I think they are hoping that real interest rates of roughly 2.5% start to pull back demand and bring inflation lower. It might take longer than they expect. So, Guy, I have to ask you, the performance of global equity markets has been incredible in contrast to global bond markets. Why do you think this was?
Well, I think it's extraordinary. Global equities found themselves in an almost Goldilocks period. Interest rates were incredibly low. The economy was recovering. They were rebuilding supply chains. And they had massive demand from these cash-rich consumers. So that rally really was a genuine normalization in their underlying businesses. The second leg of the rally came, as we know, from AI, from the technology giants, the Magnificent Seven, the semiconductor stocks around the world that embraced this new technology. By contrast, bond markets had to suddenly wake up to rates that were going to be substantially higher and substantially higher for longer, and they corrected quite sharply. For the last 2 years, they've broadly flatlined. This shouldn't be so much a surprise because bonds are returning really to their normal function, that's to provide income. And 5.5% annualised from a UK investment-grade credit portfolio is attractive today, but don't expect the capital gains that you had in the 90s and early 2000s.
And then I have to ask you, how would you really rate the pandemic bear market in contrast to all the other bear markets you've experienced in your career?
Well, the bear market began, as you know, in February 2020. It fell extraordinarily sharply, that dark red line really plunging down sharply lower, and then this rally that we saw. I've explained why. I think it was logical. I think the scale of fiscal monetary expansion was so great that it probably explains why that red line's at the top. The best recovery from a bear market we've ever seen. And looking forward, I think this continue. I think the leadership will migrate from the US super caps more internationally into more dividend-paying stocks, and particularly into some companies exposed to the extraordinary revolution in climate and decarbonisation, and that's broadly the industrials. So we're optimistic from here, but it's a different leadership. Well, thank you for listening. I'm sorry we're a little bit over time, but it's the first time we presented together. It was a great pleasure. I hope you enjoyed it. I hope you enjoyed it, Sabita.
Thank you so much, Guy.
And thank you to all listeners who've been standing behind us for these 100 issues. It's been a great honour. Thank you.